All right. So we've had wonderful discussions today and wonderful remarks from a number of people. Here we're going to talk really about fairness and how we are ensuring as we go forward that housing policy at government and among the industry is ensuring fairness. I said earlier this morning, I shared some of the background of how NAR and other industry actors and government contributed to the legacy we see today of housing disparities, which has led to the 30 percentage point gap we see between African American homeowners and white homeowners. Here we're going to talk about some of the actions we have taken as the Black Homeownership Collaborative, but also other actions we've seen in the industry and among government to take interventionist steps to close these gaps. We'll talk about what some of these actions are that we've seen, but then we'll also talk about what some of the challenges are to some of these steps. And then finally, what we need to do going forward to safeguard the progress that we have made and to do more. And with us is a great team to talk about these issues. Every one of them have been advocates and warriors on these issues and have made sure that over time that we've been in the field, in the arena where things happen, and that we've made progress and that we don't lose ground. So let me introduce the panel just very quickly. On the far end, we have Lisa Rice, President and CEO of the National Fair Housing Alliance. Barry Wheatus from the Office of Comptroller of Currency. And seated right next to me is Ken Scott, partner at Relman, Colfax. And I want to start with Lisa. The National Fair Housing Alliance is also a founding member of the Black Homeownership Collaborative. And Lisa, perhaps we can just first start by talking about some of the major activities we have seen in the last few years that have helped make housing more equitable, but also perhaps you could say a few words as well about some of the challenges those activities face. And we'll get into a more robust discussion of those challenges, but I'm very interested in hearing your insights at the outset.
Well, thanks so much, and I want to start out by thanking the National Housing Conference for sponsoring this very important convening, the 3rd anniversary of the Black Homeownership Collaborative, and to all of the organizations that make up a part of the collaborative. We wouldn't be able to get this work done without every single organization that is a member of the collaborative. I just want to, let me start out if I can by sort of framing a couple of things. Bryan, we know that the Black homeownership rate reached a recent historical low in 2019. That's when the Black homeownership rate fell to 40.6%. At that time, the Black-white homeownership rate was at more than a 30 percentage point difference. And that's a difference that we had not seen, quite frankly, since 1890. That's how much we had regressed in terms of the Black-white homeownership gap. But since 2019 to 2023, we've seen a dramatic increase in the Black homeownership rate. So remember that the Black homeownership rate actually started falling in 2004. The foreclosure crisis hit the Black community first in 2004, the Latino community in 2005, and then hit at the macro level in 2008. So Black and Latino consumers, homeowners, really were the canaries in the coal mine. So since 2004, the Black homeownership rate had been on a downward trajectory, and we turned that around. And since 2019, we've seen about a 13% increase in the Black homeownership rate and a 7.5%, almost an 8% increase in the Latino homeownership rate. And that's a very dramatic turnaround. It's an important turnaround, but it's not a turnaround that happened by happenstance. It happened because of deliberate actions that we all put in place. I'll lift up just a couple of them. One that springs to mind is bringing a little bit more clarity around the False Claims Act litigation. Many lenders were very concerned about their exposure and liability with respect to False Claims Acts when they were making FHA mortgages. And as we know, FHA plays an outsized role in providing mortgage access for Black and Latino homeowners. The second thing I want to lift up is the revamping of the qualified mortgage rule. That rule went into place as a result of the Dodd-Frank Act. The CFPB, when it first issued its regulations, there were many of us that were concerned that that rule had turned the dial a little bit too tight and had cut off access to credit. Everybody remembers Appendix Q. Very, very prescriptive piece of regulation, and it was very difficult for many consumers to implement. And so we were able to readjust and I think right-size the QM rule, and that has helped to widen the aperture of credit access for many consumers. The GSEs have ramped up their efforts to allow for rental housing payment information to be used in a more streamlined fashion in the underwriting process. HUD's Special Purpose Credit Program guidelines have really, when HUD released that guideline, it was the catalyst for many organizations to develop and implement special purpose credit programs. And we have seen since the implementation of that rule, literally tens of thousands of consumers getting mortgage credit through special purpose credit programs. There are a couple of more things I want to lift up, Bryan.
Go ahead.
We put together just a bevy of protections when the COVID pandemic hit. There were too many to name, but I do want to name a couple, just a few. The Emergency Rental Assistance Program, the Homeowners Assistance Program. For the first time in US history, we had direct benefits going to homeowners so that they would not lose their homes during that economic crisis that hit. When the pandemic hit, there were many people who were projecting that we were going to see a second major foreclosure crisis. People were calling it the COVID foreclosure crisis, the impending COVID foreclosure crisis. That didn't happen because of all of the protections that we put in place during the COVID pandemic. And then the last thing that I'll lift up is the forbearance programs that were put in place during the COVID pandemic that saved people from going into foreclosure. So, Bryan, there were many ways, myriad ways in which we created this huge homeownership and racial wealth gap in the United States. And it's going to take many, many different initiatives and efforts to get us out of this space, but it feels like we're headed in the right direction.
Excellent. Well, I love that tone of optimism. One of the items you mentioned, special purpose credit programs, really was unleashed by that memorandum you mentioned from the Department of Housing and Urban Development, saying that special purpose credit programs were consistent with the purpose of the Fair Housing Act, informing lenders that this program, which was permissible under ECOA, they could move forward with and not fear violations under the Fair Housing Act. I want to ask Barry if he could elaborate more on how the government has followed through on that, and the work that he's been doing with Project REACH on special purpose credit programs and beyond.
Sure, I'd be happy to. So the Office of the Comptroller of the Currency, where I work, OCC, is the supervisor of national banks and federal savings associations. And we supervise most of the largest institutions. And we began our journey towards helping financial institutions that we supervise address racial equity. You know, after the murder of George Floyd in 2020, we had a lot of financial institutions back in 2020 that were really coming to terms with some of the historic inequities in the financial services system. And a number of those large institutions that we supervise made racial equity commitments on a number of different fronts, including on the mortgage front. And so in 2020, the OCC formed our Roundtable for Economic Access and Change, or REACH, where we involved civil rights organizations, the banks that we supervised, other key stakeholders, including the National Association of Realtors, the National Fair Housing Alliance, and many others, to work together on a number of different fronts that address racial equity. One has to do with providing financial access for credit invisibles, another to strengthen minority depository institutions, minority-owned banks, a third looking at strengthening minority small business, and then the one that I'm the OCC staff lead for is looking at reducing the minority homeownership gap. So we are now 4 years into our Project REACH initiative. We had a summit a couple weeks ago in Washington, D.C. Several hundred people came to hear about the work that we've been doing on those fronts and to kind of envision where we're heading in the future. But to answer your question, Bryan, the work that we're doing around minority homeownership has indeed focused on expanding the use of special purpose credit programs for mortgage finance. When we started this work back in 2020, there weren't any large banks and very few financial institutions at all that were offering special purpose credit programs for mortgage finance. And Lisa mentioned, you know, one of the reasons why is that we had a lot of banks come to us as we began our discussions about ways that we can improve racial equity in the mortgage space. And a number of banks said, we would offer special purpose credit programs for mortgage. We know it's specifically authorized in the Equal Credit Opportunity Act, but there was always a lingering concern, perhaps just amongst the lawyers, but that mattered. And they said, we really need clarity that is also permissible under the Fair Housing Act. And so that is what a number of the regulators worked with HUD, Department of Justice, you know, taking these concerns from the financial institutions. And the result was a number of things: a legal memorandum that specifically stated that special purpose credit programs are permissible under the Fair Housing Act. There was a very detailed guidance that the Consumer Financial Protection Bureau put out regarding what detailed information a financial institution would need to collect and to analyze to justify why a special purpose credit program is needed and what goals they were seeking to achieve through a special purpose credit program. And then, of course, regulatory encouragement, you know, through statements, speeches by Acting Controller Sue, the head of our agency, the Comptroller of the Currency, and through our work in Project REACH. And so we formed a work group within Project REACH, specifically focused on sharing of best practices amongst financial institutions that one by one were beginning to test the waters with special purpose credit mortgage programs in certain cities on certain terms. Some were focused on people currently living in majority minority census tracts that are moving to any other census tract. They were programs different from the bank's CRA programs, which were income limited or income targeted. These special purpose credit programs were more geared to helping people, in particular racially, in certain census tracts that had high concentration of minorities. And so now, we are 4 years in. We have 12 major banks, plus both GSEs that are part of Project REACH, now offering special purpose mortgage credit programs. And the group meets on a monthly basis to share best practices, to hear about new approaches, such as those that are talked about for first-generation home buyers, which has been brought to the group. The civil rights groups are challenging the financial institutions about ways that they can expand the programs, learning from which programs are most effective. And so it's really been a wonderful collaboration. And that's just an example of how we at the federal level, working in partnership with civil rights groups, banks, and other stakeholders, can really tackle this minority homeownership gap problem.
Thanks, Barry. I think in this area of special purpose credit programs, there's just been a lot of dialogue about, how they can be tailored to be most effective. I was testifying at a hearing that the OCC, as well as the CFPB, the FHFA, and HUD had. You can look up those acronyms later. Where they were saying, we are telling lenders to move forward, to move boldly on special purpose credit programs. Why aren't they doing more? And this hearing, I was saying, yes, I think not only should they do more, but they should be bolder, and that they can be bolder based on what we understand the law to be. Nevertheless, there are many who aren't directly creating programs that deal with race. They're finding indirect ways to perhaps help African Americans and others who've been excluded, and potentially maybe diluting the effectiveness of the programs. And many, even if the executive branch is saying they support these, are still afraid of private litigation. They say, fine if Rohit Chopra says it, but some private litigant or activist is going to sue us saying it's race discrimination. So we want to hear from Ken Scott, who's at Relman Colfax, the leading civil rights litigation firm, just to tell us just how real is this litigation risk, and how much confidence can we have that lenders can create these programs and keep them going?
Thanks, Bryan. Thanks to my panelists, and thanks to everyone for being here today. Litigation, no one can say, where that's going to go. We know that there's a lot of challenges going on across the board, across all DEI type programs. I think all we can do from a litigation risk perspective is really prepare for litigation when it comes. What do we know today, though? We know that there is no special purpose credit program that's been put out by a private institution that has been challenged. And that's an important fact, right? I think if you look, there's been challenges to all types of DEI programs that are out there under Section 1981. There have been, stuff under the Equal Protection Clause, for this under state action, but nothing around kind of the ECOA and Reg B. So I think the plaintiffs bar and the folks that are really looking at this understand that just that suit is going to be a tougher suit than some of the other things that they've been doing. And why is that? If they bring something under the Equal Protection Clause, it's going to fail because there's no state action here. This is all done. Private plans don't involve state action. So we're safe from an Equal Protection Clause perspective, right? When you look at kind of the Fair Housing Act, Section 1981, all of those predated the Equal Credit Opportunity Act and Reg B. So it's clear that Congress understood that what those laws required, and they carved out this special little area that said, in lending, you can, for want of a better word, you can discriminate when you're affirmatively reaching out to groups that have been disadvantaged. So, it's pretty clear that Congress understood that, and it's a tough argument to make that it did not. And then, lastly, when you look at kind of the ECOA, it is, somebody could argue that it's state action, but it's really neutral on its face, right? It just says a private person can do this. It doesn't require anybody to do it. It doesn't say that the banks must do it. It's only when the banks decide to do it. And in that case, I think from a litigation risk perspective, anybody can bring a suit, but I think in this space, it is much safer than some of the other things we're seeing across the challenges on DEI. What I'm more concerned about is the chilling effect, though, of those other things on special purpose credit programs. Because for even those folks that have leaned in, and I think Barry, you went through that and said a number of folks have leaned in and put out special, they are all thinking about whether they should continue those programs. Because as you think, one of the questions around those programs is, why aren't the banks doing more of them? Well, if you look at it, most of the programs are structured in a way where they provide down payment assistance or closing cost assistance. So the banks have set a cost, they have to carve out a certain amount of money out of their balance sheet to be able to do this. And they're only willing to do it, but so much, right? And you have to create that imperative for them to actually do it. And why do they do it? Many of them are afraid of redlining cases. And as more and more banks do special purpose credit programs, they have expanded their credit box. And because they're doing more loans in some of these communities, when you do your traditional peer analysis, they're seeing they have exposure to DOJ and others from a redlining perspective because they're outside, their credit box is tighter. So that creates the imperative to do the special purpose credit programs. If we start seeing the reverse and banks start pulling back from special purpose credit programs, then those people that are doing it to meet, which is a significant number of them, to make sure they're not an outlier from a market penetration standpoint. I guess in this room I can say redlining. It depends on who I'm talking to. I say the redlining piece of it. People will pull back on it again. So there's a lot of things going on today, and it'll be interesting to see where folks go and whether they continue to actually use this important thing.
Yeah, if I can add one more thing to what Ken just said. The HUD regulation, as you noted, played a major role in being catalytic for the development of special purpose credit programs, but that was by design. We too had the same conversations that Barry had with lenders and asked them, why aren't you guys doing these programs? It's a wonderful way to overcome some of the systemic barriers that we see in the marketplace, including the systemic barrier of the dual credit market that exists in our nation. And we got the same information and feedback that Barry did. Banks said, our regulators, our prudential regulators have told us you may be in compliance with ECOA, the Equal Credit Opportunity Act, but you may not be in compliance with the Federal Fair Housing Act. So the National Fair Housing Alliance commissioned Relman Colfax, one of the leading civil rights law firms in the nation, and we worked together collaboratively to develop a legal sort of treatise on special purpose credit programs, which we sent over to HUD. And we did a lot of advocacy with HUD. We were joined by the Mortgage Bankers Association. We sort of plied HUD with letters asking them to issue this guidance and to review this legal document that we had prepared that laid out all of the arguments that Ken just talked about and many, many more to explain why special purpose credit programs actually further the purpose of the Fair Housing Act, particularly when one considers the affirmatively furthering fair housing provision of the law. And HUD read that legal treatise and said, you're absolutely right. And very quickly, it was in record time that HUD issued its SPCP guidance. Now, of course, we had a secretary in place, and Marcia Fudge, who was gung-ho about doing this, but I just want to sort of double down on the point that it takes a village to do this work.
And speaking more of that village, the Mortgage Bankers Association have been strong advocates for special purpose credit programs, as has the National Association of Realtors. So all of us amplifying this message that this is important and necessary to begin closing the racial homeownership gap. I want to ask the panelists, just to stick on this for a moment, what more can be done? I mean, I thought everything Ken shared in terms of why he thinks it's a good risk for lenders to take. I think that's helpful for all the lenders in the room and watching. But what else can we do to promote their use and perhaps safeguard them going into the future? You want to, Lisa, you want to take that first, or do you? Oh, go ahead, Ken.
Well, you know, I think that's a key point you said, safeguard them for the future. And that ties back to the litigation risk piece of this. And Reg B is pretty clear as to what you need to do and have in place when you have a special purpose credit program. And I think, you know, if the OCC or the CFPB or somebody comes in and you say, well, I have a special purpose credit program, that's why I'm targeting this group, and they say, where's your written plan? And you scramble to create a written plan after the fact, that's not a good place for you to be from a regulatory perspective. It's not going to be a good place for you to be from a litigation perspective as well. You need to go through the steps that's laid out in Reg B. You need to have a written plan. That written plan needs to be very clear as to the groups that you're targeting. You know, the nexus between the need that you've identified and why that group needs it. It needs to lay out what you're offering. It needs to lay out the background for the historical piece of why that group may have issues. And it needs to be laid out very clearly, and it needs to have some endpoint, and needs to be reviewed, and you need to also be monitoring it and making sure that it's operating in a way that it was designed. And if we all do that across the board, what that makes it easy for is that there's not going to be that one person out there that doesn't do it, that the plaintiff's bar or somebody focuses on, because they're very good at identifying the least common denominator. And as we know, bad facts make bad law. And so as a firm, we work very closely with our clients to make sure that, you know, we're crossing all our T's, dotting our I's as we're laying out kind of those written plans. So that would be one thought.
Barry, what else are?
Well, Lisa wants to make a point, and then I'll go.
Oh, okay.
Well, I may be stealing your thunder, Lisa, but I'll do it anyway. We have a really great set of tools that the National Fair Housing Alliance, the Urban League put together, the Mortgage Bankers Association, Special Purpose Credit Program, resource tools that provide banks in 50 of the largest cities in this country a way of analyzing how well they're doing relative to other institutions and where the need is for particular racial and ethnic groups. So I want to give a real shout out to Lisa, particularly, and her team in coming to Project REACH, speaking with our lender members that are part of REACH and saying, would this tool be useful to you? And then doing training and making the tool available for free to those institutions to do exactly what you just said, Ken, which is, you know, make the analytical case for why they're needed, to monitor the programs as they're being implemented, and to your point, protecting yourself against litigation. And I think those are all important points. And then the other thing that I would add is that, you know, we should look at where these programs are being offered now. Is there an opportunity to expand the number of markets? And make sure that the client knows where the programs are being offered, what the terms are, and how to access them. And so one of our Project REACH member organizations, the Homeownership Council of America, is launching a special purpose credit program web resource that will provide a national database of all the programs that are out there, where they're being offered, what the terms are in those particular markets, and we'll really be working very hard with housing counseling organizations across the country that are members of REACH and otherwise to help make those counseling groups aware where the programs are offered, what the terms are, because unfortunately, there's a lot of different banks that are offering them in different markets, and each market may change from year to year, and the terms may vary from month to month. And so having some tools like that available to lenders, I think, is really going to be key for the continuation of these programs.
Thanks, Barry. And the only thing that I'll do is share with people the website address is spcptoolkit.com. And I'll just give a quick shout out to Shanti Abadan and Lori Benner, who are sitting in the back. Shanti heads up our Housing and Community Development Division, and they oversee the maintenance and management of the Special Purpose Credit Toolkit. And we have many resources on that toolkit that have been thoroughly researched by our Office of General Counsel and our legal partners to make sure that those who are using the toolkit can formulate special purpose credit programs that comport with the law.
You know, can I just add something?
Please.
I think one thing that special purpose credit programs take many different but the special purpose credit programs that relax underwriting guidelines, DTIs for groups, and that perform really well, you know, they present a significant opportunity because they're almost like a pilot, right? You're piloting it on a group that's arguably a vulnerable group, and if that performs well, and at the end of the year it's doing a fantastic job, there's nothing that says that's not taking any money out of your pocket. Like, you could open that up to not just the groups you're targeting, to everybody, all the underserved groups that you may not have had a need for. Right? And if every lender does that, then we're expanding the credit box in a really meaningful way. And I think a lot of, it's one of the conversations I have with folks as I'm talking about special purpose credit programs. It becomes very difficult when it's, of course, a down payment assistance because you don't have unlimited money. But particularly on the terms and conditions, it presents a significant opportunity there, in my opinion.
Okay. Great. I mean, we've spent a fair amount of time on special purpose credit programs because it is one of the great examples of how we've made advances through our 3x30 initiative. I want to ask the panelists, what else do you think is making the most transformative change of the advances that we've made in the last few years? Maybe credit modernization? What would you like to highlight? Lisa?
Well, we talked about a couple of them at the outset. I will pick up on the thread that Barry laid down, and that's the first generation homebuyer programs. NAFA, the Center for Responsible Lending, and the Urban Institute collaborated to develop the sort of framework for first-gen home buyers. The Urban Institute did the research for us, and basically there are about 5 million capable people, sort of eligible folks who fall into that category of first-gen. 70% of them are people of color. So first-gen is a race-neutral way to achieve some of these goals that we have been setting forth. And it's one of the reasons why we are encouraging lenders who are a little bit skittish about directly using race to design their special purpose credit programs, to design a first generation home buyer special purpose credit program, because that helps you kind of get to the end that we all are trying to achieve here. Those special purpose credit programs, the reason to do them, as Ken has mentioned, is you get to change your guidelines in order to expand access to credit. So you could do things like doubling down on using rental housing payment information to qualify people. One of the challenges we face is that many consumers of color live in what we call credit deserts. They haven't had access to traditional financial services. And what that means is, since they are disproportionately accessing credit outside of the financial mainstream, they're disproportionately accessing credit from creditors who are not reporting their positive information to the credit repositories. So they may have lower credit scores, and that keeps them outside of being able to qualify, or they may have no credit score at all. So using rental housing payment information is a way to help on-ramp those consumers into the financial mainstream.
You know, the other piece of this is that with every good, there's potential bad outcomes that can occur, right? So we all have agreed here that special purpose credit programs, you know, serve an important piece of it. But as you're designing them, you know, we don't want to create a situation where we're gentrifying neighborhoods, right? We don't want to create a situation where we're forcing people to stay in neighborhoods to be able to access these programs. So there's a lot of conversation around race-based versus, you know, place-based programs. And, you know, to me, a hybrid is the better approach. Many of the programs we see out there tend to be place-based. That happens for a number of reasons. They tend to be easier to operationalize. I think NAFA and others would encourage more race-based, race of the borrower programs that allow people to move to neighborhoods of opportunity. And you know, so we've seen, I think Fannie Mae came out with an interesting program that they've been piloting where you can access, if you live in a certain place, you can access their SBCP and move to anywhere in the country, right? So you haven't locked them in. So just being thoughtful in the design, also thinking about whether you're going to go for first-time home buyers or kind of first-generation home buyers. There are just a lot of things to think through as you're designing these to make sure that you're really addressing the needs of the community and not having any unintended consequences.
Thanks for lifting that up. Barry?
I would just reemphasize the opportunity for using positive rental payment history. Both Fannie Mae and Freddie Mac have built into their underwriting models the ability to consider that information as a positive factor. I think, you know, one of the problems is that not every person is able to have their rental payment history information reported by their landlord. We have newer approaches now that are able to extract the information from your checking account data and be able to have the loan underwriter analyze that. So, you know, people who are looking to buy a home definitely need to be mindful that all this information is available, and it can be positive, to your point, Ken. But if you're not paying your rent on time, you know, it's not going to be a positive. It's going now they say that it's not a negative; it can only be a positive. But you know, that's another thing to be thinking about is how do we get people to make sure that they're aware that all this information can be used, you know, potentially in a good way to help them to become a home buyer. And we're not too far from that point where we're going to be taking some of the information that we learned from some of these models that are looking at cash flow, just looking at the cash flow in your transaction accounts and being able to underwrite you based on, you know, how infrequently you overdraft, or whether or not you are, you know, having certain payments that are due on a particular date being paid on the requisite date. And so that data over the long term is just one step away from using your positive rental payment history to underwrite you and help you, but also potentially could harm you, you know, as you look to buy a home. So, you know, working early with the housing counseling organization, helping them help the buyer understand the implications of all this and manage their finances in a way that positions them best to become a home buyer, just really is underscore the importance of the housing counselor and this whole equation as well.
So this month, which is Homeownership Month, we'll also be hearing that it's the 80th anniversary of the passage of the GI Bill, and people will be celebrating the GI Bill and how it helped millions upon millions of veterans and their families enter the middle class. We all, and at NAR, we point out that African Americans were not able to use those benefits. So the millions of veterans who came back from World War II did not have that opportunity. And as we all know, that created many of the disparities that we're living with today. So in closing, I want to ask the panelists just to speak to what else do we need to do to help more of the American public understand the need for bold action, help people understand the legacy we're trying to overcome with housing policy. And why don't we start down on your end, Lisa, and come this way?
I think one of the things that I would sort of beseech the audience to do is to compel the industry to stick with us. Ken made reference earlier to the fact that we've seen a lot of entities, particularly on the industry side, pull back. Barry talked about the commitments that many organizations made in the sort of the midst of the movements in the aftermath of George Floyd's murder. Many organizations made commitments, and we're seeing those commitments sort of be fallow. They have not been fulfilled, and I think we need to double down and stay true to those commitments. And so I would urge you to reach out to your industry partners and ask them to fulfill those commitments they made, not shy away. If they need help in how to legally fulfill those commitments, they need to reach out to the civil rights experts in order to do that, because it can be done, and there's no reason to back down from it. It's no reason to shy away from it. The Citigroup did, they sponsored research, and actually I think their economists performed this research that showed if we eliminated racial inequality against Black people alone, we would increase the US GDP by $5 trillion over a 5-year period. That's huge economic gain and benefit for everyone. We often hear from a fair housing perspective about the concern that people's zip codes are very determinate in terms of their outcomes in life. And that is true. That is true today. And I think it should be a goal of ours to ensure that every single neighborhood is healthy and resilient and replete with the resources that people need to live thriving lives. That's how we all benefit, not only individually, but as a society. And we're only going to achieve that goal of affirmatively furthering fair housing if we're all in it together. So I would encourage us to kind of double down on our commitments.
I'll just briefly add, and it's more of a state and local initiative than a federal, but the relaxation of some of the land use restrictions that we have in place, particularly as it relates to single-family zoning. I was pleased to see, where I live in Montgomery County, the planning board just proposed legislation to the county council to greatly increase the types of housing that can be built, in areas that have historically been zoned as single family. A number of jurisdictions, including Montgomery County, have already instituted policies to allow for accessory dwelling units. and more jurisdictions, particularly Los Angeles and California, have probably been leaders. So we can look to some of the states that have used, relaxation of land use to expand the supply of housing, and hopefully more affordably priced housing will come as a result of some of that relaxation.
Okay. As I think about it, we really want to think about where we are in the cycle, right? And how do we prioritize? What do we need to look at? How do we preserve the gains we have? And as I thought about it, it comes to kind of 6 things, right? And we talked about some of them. Prioritize redlining, reverse redlining, and appraisal discrimination. That's number 1. Number 3, kind of educate the public on race and place and outcome and what that means and where it is. And that goes back to Lisa hit that, do we keep financing our schools and stuff using property taxes, local property tax, that creates inequality just by the bare makeup that we have, it's based on the equity in people's houses and how much the houses are worth, and it just creates a whole disparate impact just by the design. 1, maybe we provide more Section 8 vouchers to support people moving to opportunity. Continue to push back on DEI and diversity, making sure we really building an understanding of what the equal protection laws are about and what, not use them in the perverse ways we're seeing them being used today. And stay out of the Supreme Court as much as we can. And making sure we're using the court system as effectively as we can. So potentially start thinking about state courts, state constitutions, and what they can do to help us. And lastly, protect the CFPB. And with that, that's it.
Well, I'll add just a couple of thoughts to what you all have said. The supply issue that Barry raised, I think that is really key. It doesn't solve our problems, but we need sufficient housing supply so as not to exacerbate existing problems, so that we don't have a society of haves and have-nots, and where those who are relatively advantaged can access housing, and those who are disadvantaged see their lack of access compounded. And I would also add that I mentioned a book earlier in my opening remarks called 15 Cents on the Dollar by Louise Story and Ebony Reed. I think we all need to carry the message forward that they make in this book, which is that wealth gap between African Americans and whites, where African Americans have 15 cents on the dollar that whites have, and others have said it's even greater. They say that's not going to close itself. It's not going to close by itself. That if we do everything and society is fair, it still would take about 100 years to close that gap. So it's important that we recognize that, and important that we recognize that initiatives like 3x30 are necessary, because we have to lead in order to make change. So I want to thank Lisa, Barry, and Ken for all of these great insights. This has been a wonderful panel, and thank you all for your attention.